Imagine sitting down with your morning coffee. It's mid-April 2026.
Right.
And on the left side of your screen, you've got this live geopolitical crisis in the Middle East. Global supply chains are super fragile, and interest rates just refuse to budge.
Yeah. Chaos, basically.
Exactly. Chaos. But then on the right side of your screen, your brokerage account says the S&P 500 just shattered 7,000 for the very first time. I mean, it closed at 7,022.95, and the Nasdaq just broke 24,000. So financial gravity's just, well, officially broken.
It really is this massive disconnect because, when you look out your window, you see all this global turmoil, but then you look at the ticker tape and you see this historic, just gravity-defying relief rally. It feels fundamentally wrong to a lot of people.
It feels like the market has totally lost its mind.
Yeah.
So today, we are putting on our investment analyst hats. We get this incredible, comprehensive April 2026 market research report from the Grok research team.
It's a really great report.
It really is. And our mission for this deep dive is to basically decode this bizarre landscape for you. We're going to explain the actual logic behind why the market is seemingly ignoring real-world geopolitical risks.
Right, and how that massive shift in artificial intelligence, moving from pure hype to cold, hard cash, is completely rewriting the rulebook for corporate earnings.
Yeah, so to understand this paradigm shift, I feel like we absolutely have to start with the geopolitical elephant in the room. Because from an everyday retail investor's perspective, watching a war unfold while the stock market breaks records just feels entirely counterintuitive. You expect bad headlines to equal red numbers.
You do. And let's retrace the timeline the Grok report lays out because, the market actually did care initially.
Right, back in late February.
Exactly. Late February 2026, we saw this serious conflict erupt involving the U.S., Israel, and Iran. And this wasn't just diplomatic tension. Oil shot up to nearly $100 a barrel.
Which is terrifying.
Yeah, and the market reacted exactly how you'd expect. The S&P 500 got dragged down nearly 10% into correction territory.
Because hedge funds instantly de-risk, right? Algorithmic trading programs sell on the headline volatility, and capital just rushes into safe havens like gold or treasuries.
Exactly. They price in that immediate shock. But then, we hit early April.
And a 2-week ceasefire is announced.
Right. And the market doesn't just recover slowly, it violently bounces back. It surged over 11% in a matter of weeks to hit these all-time highs.
So help me make sense of this. Why isn't the looming threat of a wider war keeping the market down?
Yeah.
A 2-week ceasefire is basically just a pause button.
Well, because the stock market, at its core, is a forward-looking pricing machine. Professional analysts and institutional money managers, they aren't pricing in today's scary headlines. They're pricing in future cash flows.
Right, usually 6 to 18 months out.
Exactly. And what the Grok report details is that the market aggressively looked through the conflict.
I hear that phrase "looked through" a lot, but what does that actually mean mechanically? Do they just put a blindfold on and ignore the news?
No, not a blindfold. It's more like sizing up the threat, running it through probability models, and then putting a definitive expiration date on it. Institutional money compared this situation to historical Middle East conflicts.
Okay, so they look at the data and say, what is the actual probability that this permanently destroys global corporate earnings?
Right. And when that 2-week ceasefire hit, the models recalculated. The market instantly priced in the assumption that the worst-case scenario, which is a massive, prolonged disruption of global energy, was just off the table.
I try to picture the stock market like a GPS navigation system in your car. It doesn't actually care about the scary, unpaved, dangerous detour you're currently driving on.
Yeah, that's a great analogy.
Right. It only cares about the final estimated time of arrival.
Yeah.
As long as the ultimate destination, like long-term core profitability, is still intact, the GPS just recalculates the route and keeps moving forward.
It does. And if you compare the speed of this recovery to the 2020 pandemic or, the tariff shocks back in 2025 in those events, the market took significant time to digest the structural economic damage.
Because supply chains were literally broken, consumer behavior completely changed.
Exactly. But here, the GPS calculated that the economic structure itself wasn't damaged. The ceasefire was just a recalculation of the ETA.
But I'm going to push back on that, though. Because isn't it incredibly naive for the market to just assume the war is over? Like we said, it's a 2-week ceasefire. What happens if these negotiations fail? A GPS doesn't know if a bridge is washed out 10 miles ahead.
It is a massive assumption, and you've highlighted the exact gamble institutional investors are taking right now. They rely heavily on data, and currently the data suggests the inflation tail risk, so the chance of $100 oil causing a global recession, has dramatically decreased.
So capital just rushes back in to buy the dip.
Yeah, but the risk is entirely real. If that probability shifts and the ceasefire breaks down, the repricing will be immediate, and it will be brutal.
Okay, so if the market is putting its faith in probability models to ignore the war, it still has to deal with the enemy inside its own house, which is interest rates. I mean, gravity should still apply to the cost of borrowing, right?
You would think so.
The macroeconomic environment right now has the Fed funds rate sitting at a neutral high of 3.50% to 3.75%.
Yeah, and let's provide some context for that number. While it is down from the peaks we saw in 2024 and 2025, since we did get 1.75% in rate cuts to get here, but 3.5% is still highly restrictive compared to the zero-interest free money era of the 2010s.
And the Fed's dot plot, their forecast for the rest of the year, only shows an expectation of maybe one more tiny cut down to 3.4% by the end of 2026. Normally, high interest rates just crush business growth. Expanding operations, hiring new staff, or building a new factory, it simply costs too much to finance.
It does.
So why isn't the cost of money dragging down these towering stock valuations?
Yeah. Well, this is where we get into the absolute core of the Grok Report's thesis. Corporate America has certainly restructured its debt, but the much bigger, far more vital mechanism at play here is the AI productivity shield.
The AI productivity shield. How exactly does productivity shield a company from a 3.5% interest rate?
So think about what high interest rates actually do. They increase the cost of capital. If a company wants to grow its profit margins when borrowing costs go up, they have to drastically lower their operating costs.
Okay, that makes sense.
And artificial intelligence has handed them the ultimate tool to do exactly that. By aggressively implementing enterprise AI, companies are just slashing their costs in software development, customer service, logistics, and data analysis.
I want to make sure I'm getting the mechanism right here. So normally it's like a company running a marathon while wearing a weighted vest. But now it's not like they suddenly put on rocket shoes to run faster. It's more like realizing you don't have to run the marathon at all because AI just built a high-speed moving walkway.
Yes, exactly.
High rates make borrowing money expensive, so companies are just using AI to do vastly more with the assets and employees they already have, totally removing the need to borrow in the first place.
That is the exact dynamic. I mean, why take out a $50 million high-interest loan to build a second factory when you can just buy a $100,000 AI software suite that optimizes your supply chain and makes your current factory 30% more efficient?
Wow. So you bypass the expensive loan entirely.
You do. That is the productivity shield in action. And the report highlights a staggering estimate from BlackRock to back this up. They say AI is currently contributing approximately 37% to U.S. GDP growth.
Wait, 37%? That is insane.
It is a structural transformation of the economy. The sheer output per worker has skyrocketed, which completely offsets the higher cost of capital. That is why the market can handle a 3.5% interest rate without tipping into a recession.
Okay, let me stop you there because that 37% number sounds amazing. But who is actually generating it? Like, are these AI moving walkways available to every company on the stock exchange? Or is this just an exclusive VIP party for the tech giants while everyone else is still slogging through the mud?
That right there is the defining question of 2026, and it explains the bizarre shape of this market peak. We are looking at a historic divergence. It's really a tale of two markets. You have the Magnificent Seven tech giants, and then you have everyone else.
Yeah, the numbers in the report on this are wild. Overall, SP500 earnings per share, or EPS, is projected to grow a very healthy 11.3% to 17.4% in 2026.
Which is great on paper.
Right. But when you split the index open, the Mag 7's EPS is expected to jump an incredible 24.4%. Meanwhile, the other 493 companies are only looking at 8% to 11% growth.
Right, so the benefits are disproportionately flowing to the companies providing the AI infrastructure. What is absolutely crucial for retail investors to understand right now is the fundamental shift in why their earnings are growing so fast.
Because we've definitively exited the hype phase of artificial intelligence.
Exactly. 2023 and 2024, they were all about the hype.
Yeah, companies just mentioning AI on an earnings call and their stock going up 5% automatically.
The old narrative was entirely about capital expenditure, or CapEx. It was just tech companies burning billions of dollars to build data centers and train massive language models. But the Grok report emphasizes that AI is now fully in the monetization phase.
It's actually generating real, monstrous revenue.
Yes. For example, NVIDIA's data center revenue is expected to explode by 65% for fiscal 2026 alone.
Wait, hold on. 65% growth on a company the size of NVIDIA. That is not a normal growth curve. I mean, that is a vertical line. Are professional analysts actually banking on that being sustainable, or is this just a house of cards waiting to collapse?
They are banking on it because the revenue isn't theoretical anymore. Look at Microsoft, Meta, and Amazon. The report notes they are sitting on cloud AI backlogs exceeding $100 billion,
A backlog meaning what exactly? Like pre-orders?
meaning signed, committed contracts from enterprise clients. Every Fortune 500 company on Earth is essentially mandated by their board of directors to spend a massive chunk of their IT budget on cloud computing and AI integration this year. Just to stay competitive, they're locked in.
Wow.
And furthermore, Alphabet and Apple are successfully monetizing AI right now in their search engines and on our daily devices.
So we have totally transitioned from the laying the railroad tracks phase of AI to the selling the train tickets phase. The tech giants built the infrastructure, and now every other business in the world has to pay the toll to use it.
And that answers the question of why institutional money is treating geopolitics as background noise. A hedge fund manager looks at a conflict in the Middle East and says, well, that is terrible, but it doesn't change the fact that this enterprise software company signed a 5-year, $50 million cloud computing contract yesterday.
Right, the money is already committed.
Exactly. This infrastructure spend translates directly into massive, predictable profit margins for suppliers like Broadcom and NVIDIA. Professional analysts call this a structural supercycle. It operates almost entirely independently of the traditional economic cycle.
All right, I'm sold on the optimism, but I refuse to believe it is bulletproof.
Yeah.
I mean, if I'm holding this grok report, there has to be a what keeps us up at night section. If over 50% of the S&P's gains in 2025 came from just 7 companies, isn't that an incredibly fragile foundation?
It absolutely is.
What if one of those giants stumbles? You can't balance a 7,000-point index on 7 pillars forever.
You can't. Concentration risk is the dark shadow following this entire rally. To understand how the market plans to survive it, we really have to look at market breadth and what happens to traditional sectors next.
Let's dig into that breadth, because the report points out that the broader economy outside of tech is actually showing remarkable resilience. U.S. GDP is expected to hold above 2.2%. And in the first quarter, we actually saw regional banks and industrial manufacturing companies beat their earnings expectations. Plus, you have the current administration's pro-growth policies, like tax cuts and infrastructure spending, and lower than expected wholesale inflation. That seems to set up a very favorable macroeconomic backdrop.
It does, and what you are describing is the earnings diffusion phase. Those banks and industrial companies beating expectations. They are doing it because they are finally deploying the very AI tools built by the tech giants.
Ah, so it's the trickle-down effect of productivity.
Exactly.
Give me a concrete example of how that diffusion works in a boring, non-tech industry.
Okay, take a mid-sized logistics company. They aren't building language models, but they purchase an AI routing system that analyzes global weather, traffic, and port congestion in real time. Suddenly, their fleet uses 15% less fuel.
That's a massive saving.
Huge. Or look at a regional bank. They implement an AI system to instantly process loan applications and verify documents, which allows them to cut their back-office workforce by 20% while processing loans twice as fast. Wealth and efficiency are finally spreading beyond the Silicon Valley bubble.
And if we factor in the Federal Reserve into this diffusion, like if they actually execute that expected rate cut later this year, it acts like a massive tailwind for these traditional sectors, right?
So it is pure oxygen. Tech companies sitting on mountains of cash don't really care much about borrowing costs, but a heavy machinery manufacturer with a massive payroll.
Right.
Or a regional bank managing a complex loan portfolio.
Right, they feel it.
For them, a rate cut unburdens their debt. It allows them to take the efficiency they gain from AI and pair it with cheaper capital to actually expand their physical footprint.
Okay, so we've painted a very clear picture of this AI supercycle, the earnings diffusion, and the potential for rate cuts. But let's make this real for you listening right now. If you are an everyday retail investor trying to navigate this, you can't just set it and forget it on blind optimism.
No, you definitely shouldn't.
What breaks this cycle? What are the specific, actionable warning signs that this golden scenario is reversing?
The Grok report is very explicit about the storm clouds. Retail investors need to actively monitor 3 major risks to protect their portfolios. The first is a breakdown of the fragile ceasefire in the Middle East.
Okay.
The second is AI concentration risk, specifically regarding return on investment. And the third involves lingering impacts from the 2025 tariffs and global supply chain disruptions.
Let's drill into each of these so we know exactly what to look for. Started with the geopolitics. We talked about how the market looked through the war. What happens if these peace negotiations suddenly collapse next month?
If the talks fail and the conflict reignites, the relief rally evaporates instantly. The probability models will just flip. Oil could easily surge past $100 a barrel again.
And mechanically, how does that bleed into the stock market?
Higher oil immediately punishes non-tech sectors that are highly sensitive to energy and supply chain costs. Think airlines, global shipping, and heavy manufacturing. But more importantly, $100 oil reignites inflation at the consumer level.
Which the Fed hates.
Right. If inflation spikes, the Fed is forced to abandon any planned rate cuts and might even have to hike them. You would be staring down a classic stagflation scenario.
Where economic growth freezes, but prices keep rising.
Exactly. The AI productivity shield might not be powerful enough to save the broader market if energy prices completely choke the everyday consumer.
So what is the actionable indicator there? What should I be typing into my finance app?
Monitor daily oil prices. Specifically, look at Brent crude. If you see it holding consistently above $90 a barrel or testing $100, that is your early warning system. That means the geopolitical risk is no longer background noise. It is bleeding back into the real economy.
Watch the Brent crude ticker.
Yeah.
Got it. Now, what about the second risk, the AI concentration? How do we actually measure if the AI bubble is popping?
This requires you to look past the headlines. You need to meticulously track the ROI metrics, so return on investment, in the upcoming tech earnings reports.
But how does a retail investor do that? It's not like the companies broadcast, hey, our ROI is bad.
No, they don't, which is why you have to listen to the Q&A section of the earnings calls. It is no longer enough for Microsoft or Meta to proudly announce they spent another $10 billion on new AI chips. You have to listen for whether everyday enterprise clients are actually paying enough for those AI software subscriptions to justify the massive hardware cost. If you start hearing that corporate clients are canceling their cloud contracts because the AI features aren't actually saving them enough money, the foundation cracks.
Because then the Magnificent Seven's EPS projections will collapse.
Exactly, and because they make up so much of the index, they will drag the entire SP 500 down with them.
Okay, and the third indicator to watch.
Watch wholesale inflation data. Specifically, you want to track the PPI, or Producer Price Index.
Why the PPI instead of the standard consumer inflation numbers we always hear about?
Because the PPI captures the cost of goods before they reach the consumer. It includes the raw impact of those lingering 2025 global tariffs and supply chain bottlenecks. If the PPI spikes, it means corporate profit margins are getting squeezed at the source.
And if margins get squeezed, that beautiful earnings diffusion we talked about in the traditional non-tech sectors will just freeze in its tracks. You know, it is the ultimate irony for retail investors right now. Traditional financial wisdom, like the stuff your grandfather taught you about the stock market, says don't put all your eggs in one basket. Diversify.
Right.
But the current macroeconomic dynamics are essentially forcing investors to huddle inside this giant glowing AI basket just to survive the high-interest, high-conflict environment.
It really is an uncomfortable reality for anyone managing a portfolio today. Being underallocated in technology right now is functionally equivalent to shorting the market's only real engine of growth. You have to participate in the AI supercycle to capture the gains, but you have to do it with your eyes wide open to the concentration risk.
Let's distill all of this down. The reason your brokerage account is breaking all-time highs, with the S&P over 7,000 and the Nasdaq over 24,000 amidst ongoing global conflict and elevated interest rates, boils down to what the Grok report calls AI-driven American exceptionalism.
That's a great way to put it.
Right. The institutional money has done the math. They are treating geopolitics as temporary headline noise because they are hyper-focused on the tangible, historic profit margins being printed by the technology sector as it shifts from AI hype into massive structural AI monetization.
Precisely. The market isn't ignoring the war out of ignorance. It is coldly calculating that human conflict won't permanently derail the historic structural transformation AI is bringing to corporate profitability.
Which brings us back to where we started. The eerie disconnect between human anxiety and market gravity, and it leaves you with a final, lingering question to ponder. If artificial intelligence's sheer productivity is already powerful enough to shield the stock market from actual wars and high interest rates today in 2026, Well, what happens to the global economy when AI becomes even more autonomous in the future?
It's a huge question.
Will our financial markets eventually detach from human geopolitical drama entirely, trading purely on machine-to-machine efficiency, completely oblivious to the chaos outside our windows?
It is a fascinating and, perhaps slightly terrifying possibility to consider.
Definitely something to think about the next time you look at the morning news and then look at your portfolio. Keep your eyes on the data, watch those 3 indicators, and we'll see you on the next deep dive.